Hi, so today I'll be explaining about candlestick patterns. So, what actually are candlesticks and what are the different kinds of candlesticks that are available for trading? So, first of all, candlesticks are nothing but the fluctuation of price within a given frame of time within a given candle. So, suppose if we are taking a 1 minute candle, so it will be showing the price fluctuation within that 1 minute, and it will be represented by four different stages. There are the open, low, high, and the close. So basically it represents the movement of the price within the time period that we select. Suppose we select a 1 minute candle, then it will be showing the movement of price within that 1 minute within that candle. Then we can select different types of time frames also, which are available, like 5 minute, 15 minute, 30 minute, 1 hour, then 1 day, which is the daily candle, and then the weekly and the monthly candles are also available. There one candle is equal to 1 month, one candle is equal to 1 week, one candle equal to 1 day, like that it is. So here what we are seeing, that first of all, the body of the candle is actually the open and the close values. So whenever it will be a bullish candle, a bullish in the sense means it will go up, means we are assuming that the price of the stock or the index will go up from the next candle. So it can be any candle, like it can be a daily candle or a weekly candle or a 5 minute or 15 minute candle. So here it is showing that the open is low and the close is in the high. The four things are mentioned here. So whenever it will be a bullish candle, the open price will always be below the closing price, which means that suppose any stock which is opening suppose at 100 rupees and it is closing higher, suppose at 105, so obviously the open will be lower than the closing price. And suppose if the candle is showing that the price is falling, suppose the open price is 110 and the closing price is 107, suppose, so it will be represented by a red candle, and it will always be, the open will always be at the top and the close will always be at the bottom. And apart from that, there will be the high and the low values, means it will show that how the price is moving within that time frame. Like it will be going high, then it will again come down low, then again it will open somewhere and close somewhere. So that open and the close, that range is termed as the body of the candle, and the high and the low represent the shadow or the wicks. So basically this open and the close are the main thing which represents the body of the candle, and the wicks and the shadows only show the price reaction, like where it went and from where it reversed up to which point it went, that it represents the shadows. So next we will be studying today the different types of candlestick patterns that are available. Among the bullish candlestick patterns, there are the bullish harami, hammer, inverted hammer, bullish engulfing, morning star, three white soldiers facing line. And among the bearish patterns, there are the bearish harami, hanging man, shooting star, bearish engulfing, evening star, three black cross, and dark cloud cover. So each of these patterns are the opposite of the other one. So bullish harami, its opposite is bearish. Hammer, its opposite is hanging man. Inverted hammer, its opposite is shooting star. Bullish engulfing, is opposite is bearish engulfing. Morning star of evening star. Three white soldiers opposite, three black crows. Piercing line opposite, dark cloud cover. So you can see here that first of all, the candles which we will be studying, there is a doji and the marubozu, we will be studying with those two. Those are the single candle patterns, means only one candle. Then harami, hammer, all these are one candle patterns. Inverted hammer, shooting star, and all. And from bullish engulfing onwards, those are the two candle patterns, means the pattern is formed with combination of two candles. These engulfing candles, morning star, evening star. Then from this three white soldiers, morning star, evening star, these are three candle patterns. then again piercing line, dark cloud cover, that is a 2 candle pattern. So various types of candle patterns are available. So we will be starting one by one. First we will be studying about the doji. So the doji is nothing but the indecision. It shows indecisiveness in the market, means the buyers and the sellers, a fight is going on between them, like the buyers want to push the price higher and the sellers want to push the price lower, and when the price is not going anywhere, like it is closing near its open value, like the doji, which is represented by a small plus sign. It looks like a small cross, or you can say a small plus sign, where the open is very equal to the closing value. That represents a doji. And there are different types of doji. One is dragonfly doji, one is gravel stone doji, one is long-legged doji. So first of all, we will study about doji candle. So doji, like I said, the open and the closed values will be very much near to each other. So the body will form a very narrow body, and the wicks will also be small. So it will be a small plus kind of a pattern. So whenever we are treating a doji as a reversal pattern, so it is actually treated as a reversal pattern only. So when we are assuming that it is a reversal pattern, so like we will try to trade it in the opposite end. So basically all the bearish candlestick patterns, they form at the top, and on the bullish candlestick patterns, they form at the bottom. So we assume that these candlestick patterns are all reversal patterns, but there are some continuation patterns also, which we will discuss later. So doji, basically we assume that it gives a reversal, means it shows indecisiveness in the market. But in general, like doji can go in both ways actually, means it all depends on the breakout or the breakdown. So here I will zoom and show you. So this is the doji candle. It is formed at the top of the price action. So price action is actually nothing but a combination of candles. Like here we are seeing one candle, one candle. Each candle is representing its own story of the price within that candle, within the given time frame. So when we combine a lot of candles, like around 10, 20 or 50 or 100 candles, it forms a kind of a pattern, which is called as a price action pattern. So whenever market is in an uptrend, it will be forming a higher high and higher low pattern. Like this, it will go up and then it will come down, then again it will go up and then it will come down again, then again it will go up, like that. And if it is in a downtrend, it will come down, then again it will go up, then again come down, then again go up, then again come down, then again go up. So it will be forming higher high, higher low, then again higher high, higher low. That will be for an uptrend, means a trend which is going up, and when it will be coming down, it will be forming a lower low, lower high, lower low, lower high. That will be for a downtrending market. So the doji here we are seeing that it is forming exactly at the top of the price action. So basically the pattern looks like a doji, and it can be treated depending on the breakout, on which side it is giving the breakout or the breakdown. So the breakout means when price is going above this doji pattern. So if the price is giving a breakout and going up, then that is called as a breakout. And if the price is going downside, means if it is breaking the low and going down, then it is called as a breakdown. So the way to treat this doji candle is, we have to take our position at the top, that is at the high of the candle, and we have to take 1:2 as the target. So suppose this doji candle, this height of this candle is suppose 10 points. So we will take our target as 20 points. So we will be buying here. So if it is 10, a little bit above this candle, like at 11 point we will buy, and we will keep 20 points as the target. So around 31 points will be our target, and the stop loss we can keep at the low of the candle, means at the bottom, little bit lower than the bottom. Sometimes what happens that price comes down, touches the bottom, here you can see, and then it again goes up, again it went up in the next candle. So you can keep a little bit below the low of the candle, that we can keep as the stop loss. So the basic way to treat the doji is, whichever side it breaks out or breaks down, on the upside or the downside, that way we have to trade. Next is the Gravelstone doji. It is another type of a doji pattern. So here what happens, here the open, low and the close are almost equal to the same value, and there is a big price rejection. Now what is price rejection actually? So here try to see what is happening. So first of all, the price opened here at the bottom, then it went up to the high, means there was some buying going on here. The buyers tried to pull the price higher, and from there it came down, means the buyers could not take the price higher above this value, and then it came down, and at the bottom it had to settle at the bottom. Means what happened, that the sellers became powerful now, they became more active, they didn't let the buyers go up above this level, and they pulled the price down and let it close near the low value. So this kind of price rejection when we are seeing on the upside, it signifies that the sellers are in control, means it is a bearish candlestick pattern. So this bearish candlestick patterns, they all are formed at the top of the price action, and whenever it is a bullish candlestick pattern, it is formed at the bottom of the price action. So other than this, if you are finding these kinds of patterns in the middle or in the opposite ends, then it is not much reliable. So we will explain this one next. So see, this is an uptrend, it is going up, price is going up, and we found the Gravelstone doji at exactly at the top of the price action. So if this doji was found somewhere in the middle or at the bottom or at the opposite ends, then it won't have been that much reliable. So based on that, whichever pattern we are forming, it has to form according to the type of pattern it is. So here we have to trade it in the same way as the doji. So we will be taking our trade at the bottom of this candle. We will take 1:2 as the target, and we will keep the stop loss at the top of this Gravelstone doji. Little bit slightly 1 or 2 points above the top, we will keep the stop loss, and we will trade from this low, and we will take 1:2 as the target. Same, the next one is the opposite, that is called the Dragonfly doji. Yeah, the open, high and the close are the same, and the low is print. It is forming a big price rejection on the downside. So this is just the exact opposite of the Gravelstone doji. In Gravelstone doji, what happened actually, in the open and the low and the close were all equal. Price went up like this, and the bulls tried to take the price higher. There was a price rejection, and then it came down. But here what happened, here first of all the price went down, the sellers were in control, but the sellers couldn't take the price below this lower level, and then came the buying, and it went up and the price settled at the higher value. So this kind of a price rejection, when it happens in the lower side, it indicates that the buyers are in control. So whenever we are seeing a price rejection on the downside, so that is an indication of a bullish signal. And whenever the price rejection is happening on the upside, like the Gravelstone doji, it is an indication of a downside. So this also same way we have to trade. So here we found out that it is forming at the downtrend, at the bottom of the downtrend. So we will be taking our trade at the top of this candle, exactly at here at this point, and from here we will take 1:2 as the target, and we will keep our stop loss at the bottom, little bit lower the bottom of this candle. Next are the spinning tops. Spinning tops are exactly similar like the doji pattern, so only difference is the body. Like in the doji, the body was very narrow, means very small, narrow range it was, and the opening and the closing values were almost same. But here the body is little bit wider, and the wicks, the shadows are also little bit longer compared to the doji. So we can say that if the doji was a small plus sign, so this spinning top is a little bit bigger plus sign, means it indicates a bigger indecisiveness in the market, means it can go in either way, and it can be taken as a sign of a weakness, means doji is a reversal pattern but can be treated in both ways, but this spinning top is a indication of weakness, means this also can be treated as the same way as the doji, means by seeing which way it is giving the break on the upside or breakdown on the downside, and then we can take our target with 1:2 towards the target, and we're keeping the stop loss at the opposite side, at the top of the opposite side or at the bottom of the opposite side. This is an example of the spinning top. It is formed at the top, so it's given breakdown on the downside. So here we would have taken our trade. So we have got 1:2 towards the target, and we could have kept our stop loss at the top. Next is the Marubozu candle. So this is an exact opposite of the doji candle. In doji, the body was very narrow and the wicks were very long, but here there is no wick. Like all there is the only thing that exists is the body. So we can see that here the open is equal to the low and the close is almost equal to the high value. Means wherever it opened, that was only the low value, and wherever it closed, that was the highest value. It closed very near to the highest value for a bullish Marubozu candle. For a bearish Marubozu candle, exactly the opposite. Where it opened, that was the highest value or near to that, and where it closed, that was the lowest value or close to that. In Marubozu candles, like there are very small wicks or almost no or negligible wicks are there. All completely it is the body only. It shows that super bullishness means it is very strong indicator, like it will be going in the upside, and this is a very strong indication that it will go on the downside. So it can be treated in both ways, either in a reversal pattern or as a continuation pattern. So here we can see that the price was coming down a little bit like this, price action, lower low, lower high, lower low, lower high, and then suddenly a bullish Marubozu candle is formed here in the green. So we had to trade at the top of this Marubozu candle. We can take our trade, and we can take 1:2 as the target, and stop loss will be at the bottom of this candle. So here it acted as a reversal pattern. It didn't go down further. Price was going down, but this didn't go down. It reversed from here. And an example of a bearish Marubozu. See here, it is going down and it continued the downtrend. It formed here and it continued forming lower low, lower high, lower low, lower high like that, and lower low, lower high, and again a new lower low and new lower high. So here also, if we had to trade, so a big red Marubozu candle, we could have taken our trade here at the bottom of this big red candle and taken 1:2 target and stop loss at the top of this candle, and it can act both as a reversal pattern as well as a continuation pattern. In this case, it is forming a continuation of the trend, and in the previous example, it formed as a reversal of the trend. Next is a bullish hammer candlestick. So hammer here it is showing two candles, but actually it is a one candlestick pattern only. Just for comparison I'm showing. So this is a bullish hammer. It can be either green or it can be red. The color is not much significant. What is significant is the shape of the pattern. It looks like a hammer, and this wick will be almost twice the size of this body. So body means open and close values of a candle. So this is the body. So this wick, the price rejection will be almost twice the size of this body. So this hammer pattern is a bullish candlestick pattern, and it forms at the bottom of the price action. So here we can see the price was coming in a downtrend, then it formed here. Then if we had to take our trade, we could have taken our trade here at the top of, here means at the top of this candle, and 1:2 ratio, target, stop loss at the bottom, and here it is mentioned this long lower should be at least twice the size of the hammer body, which I already mentioned. The body which is forming this wick has to be twice the size of this body. And this same thing, if it is happening on the upside, it is called as a hanging man. See, there is no change. See this one, this was the bullish hammer, same thing, nothing different. This is also the same thing. Only difference is hammer is forming at the bottom, hammer is forming at the bottom of the price action, and hanging man is forming at the top of the price action. So same way to trade. If it is at the top, so at the bottom we have to take our trade, and the top we have to keep our stop loss. 1:2 is the target. Next is the inverted hammer. So inverted hammer, from the name itself we can make it out that it is the opposite of the hammer, which is the inverted pattern. But the main thing is that it is not the opposite of hammer, it is also a bullish pattern actually. So from the name it sounds like if hammer is a bullish pattern, then inverted hammer might be a bearish pattern, but it is not like that actually. So both hammer and inverted hammer both are bullish patterns. The pattern looks different, it looks like an opposite of a hammer. In a hammer there was a body and the long lower wick was there, but in inverted hammer body is there and the long upper wick is there. So that's why the pattern, by the pattern the names are different due to the pattern, but both are bullish patterns. So see here it is coming in a downtrend, so an inverted hammer. So if we had to trade here at the top of this, we would have taken our trade, and at the bottom we could have kept our stop loss wisely to the target. Same thing, see here also it is written the wick should be 2 times the size of the body. So exactly the opposite of hammer. This is the inverted hammer, but both are bullish patterns. So same thing when it is happening on the upside, that is called as a shooting star. See, no difference is there. Inverted hammer, same thing, shooting star, no difference. Only difference is it is occurring in an upside, in an uptrend. Shooting star, it is happening at the top of the price action, and inverted hammer is happening at the bottom of the price action. Same way like in hammer it was there, hammer it was forming at the bottom of the price action. The same thing when it was happening in the top, it is called as a hanging man. Same way inverted hammer forming at the bottom, and same thing when it is forming at the top, it is called as a shooting star. Same way to trade, at the bottom we take our trade 2 times, and at the top we keep our stop loss. Next is the bullish engulfing pattern. So from now on we will be trading with 2 candles, like the pattern will be formed with 2 candles. So here it is a bullish engulfing pattern, so it forms at the bottom of a downtrend. So what happens actually, the first candle will be a red candle, means it is coming down. So the next candle opens gap down. So gap down means, in the sense, gap means when there is a difference in the price between the closing price or an opening price, or a high or a low price, that is called as a gap. So suppose this candle closed at suppose 100, and the next day it opened gap down. So if it is opening below this 100, so suppose it opened at 95, suppose, so there is a gap of 5 points, and this is called the gap. Since it opened in the downside, so it was a gap down. So suppose this closed at 100 and next day it opened gap down at 95. So in this kind of pattern, what happens, in a negative red candle it is closing, next day it is opening negative only at the gap down, then it goes up and forms a big green bullish candle, and it closes above the high of the previous day candle. See, in a downtrend it was going down, so next day it opened gap down and a big bullish candle is formed, and it is closed above the high of the previous day high. So here if we are to trade here, so we have to take the high of this candle, and from here we have to take our target as 1:2, and we have to keep our stop loss at the bottom of this candle. And this is also called as an outside bar, because this is completely engulfing the previous candle. So means engulfing means this small candle is coming entirely inside this big candle, within the range of this candle. So it is called as a engulfing pattern, and this is also called as an outside bar. So we have to trade this one at the top of this, and we have to project it 1:2, and we have to keep our stop loss here at the bottom. Same way for the bearish engulfing pattern. So earlier it happened in a downtrend, so this will happen in an uptrend. So same thing. So bullish candle, next day gap up. So suppose it was at 100, opened higher, suppose 103. Then there was a gap of 3 points. Then it came down and big red bearish candle, and it closed below the low of the previous day candle. Same way, uptrend and bullish candle. Next day opened up, came down and closed below the low of the previous day candle, and it completely engulfed the previous day candle. So if you have to trade here, you have to take a trade at the bottom of this candle, and you have to take 1:2 towards the target. So next is the pressing line pattern. So it is same like the engulfing pattern only. So that was on the, and here what only the difference is that it will also open gap down and big red candle gap down, then going up. Engulfing, what used to happen, we used to completely engulf the previous day candle and it used to close above the high of the previous day high, right? But here what will happen, that it won't go all the way up, it will go only 50% or little bit higher above the 50% of the previous day candle and close within this candle only. So that is called a piercing pattern. Same way, a piercing pattern, I will show the difference. Bullish engulfing, red candle gap down, opened, went all the way up and closed above this previous day high of the previous day candle. And piercing pattern, red candle gap down, went up but didn't go all the way up, it went only 50% above the previous day candle and closed somewhere in the middle. So same way to trade, two candles are there. Second candle is the breakout candle, so we have to trade above this candle and we have to keep the target 2 times, and bottom will be the stop loss. The same way is the cloud cover, it is the opposite of the this bearish engulfing pattern. Same bullish candle gap up, came down all the way and engulfed the previous day, closed below the low of this candle, but here it don't close, gap up, came down all the way but didn't go all the way, and it went only below the 50% of the previous day candle and closed somewhere in the middle. So same thing, close somewhere in the middle, and if you have to take the target, you have to take somewhere here. So it was a big price rejection happened here, so somewhat it was like a bearish engulfing pattern only, but what happened is that it closed within this range of 50%. So whenever it is forming like that, so you have to take the body. Body is the most significant, like the wicks and all are not so much important. So if your body is forming a pattern and the wick is showing another pattern, so you have to take the pattern which the body is forming. So the body is forming a dark cloud cover pattern, so you have to take our trade at the bottom of this body and we have to take 2 times the target, and we have to keep the stop loss at the top of this candle. So next is the harami pattern. So harami pattern is also called as the inside bar. So previously engulfing pattern was an outside bar and harami pattern is called an inside bar, because what happens is, see here, this big candle and the next candle is within the range of the previous candle. I'll show you here. So price is coming in a downtrend, so big red candle and the next candle is completely within the range of the previous day candle. So if it is a bullish pattern, so next day it will open gap up here. It was this one, sorry. This was a bullish candle, this one, it was in a downtrend, a bullish candle, it opened higher than the previous close, means a gap up happened here. It closed here and it opened here, gap up happened and it closed somewhere within the range of the previous day candle. So this is a bullish harami pattern, so we need to trade here at the top of this wick and we have to take our trade as 1:2. We have already been following this technique. So for all the breakouts of all the patterns of the candles, we have to take it like that, and the bottom will be our stop loss. The same way for the bearish harami, if it is going up, so this was a strong bullish candle, next day it opened gap down and then it stayed within the range of this previous day candle. So what you have to notice is that the body should be within the body. If the wick, suppose the body is inside and the wick is outside, this range, then it's not that much significant. What is significant is that the body should be within the body of the previous day candle. Then it is a completely inside candle. So inside bar, you can say that. So in engulfing, a small body was there and the big body. Second one was the big body, as it was an outside bar, and this is the opposite. This is the big body is first and this small body is the second one. So here this one will be an inside bar, and you have to trade it the same way. This below this week you have to take our trade, you have to take 2 times, and the stop of this candle will be your stop loss. Next is the morning star. So this is a 3 candle pattern. From now on we will be discussing the 3 candle patterns. So I'll explain you here. So it is in a downtrend. So big red candle, and here what happens is that after the big red candle is formed, the next day a gap down is formed, a candle, and the whole day this candle stays within this range only. It doesn't goes or touches the body of the previous day candle. It will stay outside the range of the body of the previous day candle, and the next day again it will open gap up and it will close somewhere within the first day range of the body of the first candle. See here, this was a red candle. The next day it opened gap down and it remained the whole day within this range. It didn't go within the range of the body of the first candle, and next day again gap up. The third candle, it went within the range of the first candle and closed somewhere within this range only, within the range of the first day candle. And there is a morning star pattern. So if you have to trade it, the third candle, breakout candle, always remember whenever we are trading with any 2 candlestick patterns, so the final candle which giving on the top of this 2 times, and the bottom of this candle will be your stop loss. Same, the opposite of morning star is an evening star. So this is a bullish candle, it is going up. Same, the opposite. Then the second candle will be this one, gap up, and the whole day it will be staying within this range. It won't come within the range of the body of the first day of the candle. It will stay within this range only, and then third day it will come gap down and it will close somewhere within the range of the first day candle, like that. Goes in an uptrend, closes higher, second day gap up, and whole day stayed within this range. Third day came down, gap down, and closed within the range of the first day candle. So this is an evening star. If we are to trade the third candle, which is the breakdown candle, below the low of this candle, here we have to take the trade, and we have to keep our target like 2 times, and our stop loss will be at the top of this candle. And the last one is the 3 black crows. So 3 black crows is also a 3 candle pattern. It forms at the top of a price action, and this is a bearish pattern. So how to identify this one? So first of all, I'll explain you here. One red candle opened here, closed here, right? The second one opened within the range of the first candle. You can see here, preferably if it opens below the open of the previous day and within the middle of the first body, then it is a perfect 3 black crows. So I see here, this was the open and this was the close. Then next day again it opened here. It opened below the open of the previous day and it opened somewhere in middle in the first day candle, and it closed below the first day candle. And again the third candle opened below the second day candle open, and it opened somewhere within the middle of this second day candle range, and it closed below the close of the second day, like that. And then it is a 3 black crows. So we have to take our trade at the bottom of this breakdown candle, and we have to take 2 times as a target. And the opposite of this is the 3 white soldiers, the same thing. So it will occur in the downtrend, so it will go up. So same, this is a bullish one, so the open is downside and the closing is on the top. Open and close, second candle open above the previous first day opening, preferably in the middle of the first day candle, and it closed higher above the high of the first day candle, and the third candle also it opened above the this opening of the second day candle, and it closed higher above the high of the second day candle, and it opened somewhere in middle of the second candle. So this is a three white soldier. So just remember it like this. So like first candle is green, open and close. Second candle open within the middle range of the first candle, and then it closed higher. The third one like either in the middle or in the other top of the second candle, and it closed even higher. So we have to trade at the top of this candle, and we have to take 2 times as the target, and our stop loss will be the bottom of this candle. So these are basically the main candlestick patterns which I have tried to explain you. So if you are having any doubts, then you can ask me. So like this should be enough for today. So hope you understood all the types of candlestick patterns that I have been trying to explain you. So hope everything is clear. So you can ask me your doubts then. Thank you.